Good afternoon, everybody. I might just give a minute for everyone, for more people to join, and then we'll start. But thank you very much for making time this afternoon. Right. Well, thank you, everybody. I'm sure we'll have some more people joining us over the coming minutes, but just want to say good afternoon. My name is Craig Evans, and I'm Head of Economic Policy here at the Australian Banking Association. Thank you all for joining us this afternoon for this, which is our second economics webinar series for 2025. This is a series exclusively for ABA members and stakeholders. And we start our webinar today by acknowledging the traditional owners of the lands on which we meet, and I pay my respects to their elders past and present. For us at the ABA, we are located on the traditional lands of the Gadigal people of the Eora Nation. The session today will be a panel discussion centered around the topic of headwinds and tailwinds for banking, and we'll cover the macroeconomic factors likely to inform the banking sector's growth trajectory and how these might play out across bank balance sheets and profit and losses. So today I have the pleasure of handing over to our moderator, Steve Jackson. Steve is a partner in KPMG's Banking and Capital Markets team in Australia. He specialises in global banking and capital markets and has worked for KPMG in both the UK and Australia. He currently leads the firm's relationships in both foreign banks and challenger banking segments, as well as supporting a broader range of global financial services institutions. Before I hand over to Steve and the panel, there will hopefully be an opportunity following the panel for people to ask questions and for some discussion. Please feel free to send through any questions that you may have during the discussion by using the Q&A tab, which can be found at the top of your screen. With that, over to you, Steve.
Craig, and thank you to the ABA for hosting today's session. As Craig mentioned, our topic is headwinds and tailwinds for banking. Little did we know when we were setting the theme just what was in store for the global economy in the first few months of 2025. We've seen the emergence of a global trade war sparked by US tariff policy that's rippled through the global equity markets and set the scene for a fundamental reshaping of international trade flows and supply chains. This has come at a time when economies around the world are grappling with the sticky tail end of a rapid inflationary cycle, casting doubt over the stabilisation of economic growth and the forward path for interest rates. At home, we're in a federal election campaign cycle where we see the debate centering around cost of living, housing, and a significant spending agenda. And amongst all of this, who has become the new rock stars? The big names in the headlines, the people whose words we all hang on. That's right, it's the economists. We've got a great lineup of speakers for you today, including two rockstar economists, an industry-leading banking analyst, and an executive committee member from a major bank. So a little bit about our panel before we begin. Lucy Ellis is Chief Economist for the Westpac Banking Group. She was previously Assistant Governor Economics at the Reserve Bank of Australia and held several other positions at the RBA over a 3-decade career in central banking. Warren Hogan is Judo Bank's Chief Economic Advisor. He's also the Managing Director and founder of EQ Economics. Richard Wiles is a Managing Director who covers Australian banks and is the Head of Research for Australia at Morgan Stanley. And Claire Morgan leads the Australia commercial business at ANZ, serving over 650,000 small to medium-sized business customers. Welcome to all of our panel members. Our running order for the session today will be to start with an economics bake-off with Lucy and Warren. Each of them are going to give us their predictions on the big economic forces shaping the Australian economy. Then we'll hear the analyst perspective from Richard, who'll talk about how these forces are impacting our banks, what shape they're in as we enter this next phase, and how these forces will impact key metrics. And last but not least, we'll have a Q&A with Claire, who'll talk about how bank strategic priorities are being shaped by all that is happening around us in the world. She'll speak about growth opportunities, new and emerging risks, and where the voice of the customer sits amongst all of it. At the back end of the call, we'll try and leave some time for one or two questions from our audience. So let's get straight into it. Lucy, what are your predictions on the economic forces shaping the Australian economy and how these will impact our banking system?
Thanks, Steve. Well, I've just got back from a 3-week trip through UK, Europe, and North America. And what a time to be talking to our global customers when all of the trade turmoil was unfolding. But what the events of recent weeks have been in the context of is a range of big forces shaping our economic future. And the first of these is one we've been talking about for quite some time, which is that the global structure of interest rates will be higher going forward than it was in the period between the global financial crisis and the pandemic. And this stems from, among other things, the global savings investment balance, the lack of central bank quantitative easing, the fact that most of the capital build-up in the post-GFC Basel III is now done, so you don't have to do additional savings for that. And while Asia remains a big pool of global savings, it's not an even bigger one than it used to be. And so all of the additional desires for investment coming from AI, climate transition, and government spending are sort of flowing into a savings investment balance that just will equilibrate with a higher rate structure. And this has a range of implications beyond the rates themselves. It has implications for fiscal policy, for investor behaviour around search for yield. Although, of course, Australia is mostly floating rate, and so you didn't have that same search for yield behaviour in the local market that you saw in Europe. And I would regard Australia as being pretty well placed to manage this shift, but it is a shift that is important to understand. Now, more recently, we've, of course, seen a lot of market response to what's been going on in US policy. If we'd been having this seminar at the beginning of the year, we would have been talking about US exceptionalism. And while I would have been a bit sceptical of it at the time, because the US dollar is overvalued and the US is uncompetitive at current exchange rates, I was surprised just how quickly that narrative busted. And so where we are now is that global investors are sort of a bit at odds. I mean, they're concerned because they're very long US dollar assets, they're very long US treasuries, but there is they have a TINA problem. There is no alternative to US treasuries as a risk-free asset if you're a global investor. But on the other hand, markets can reallocate assets easily. And so I wrote a client note summarising what I learned while I was away, titled "Tina McRae says watch out ahead." So there is no alternative to US treasuries, but markets can reallocate assets easily, and it's flows that drive pricing. So we will see a lot of market volatility as that narrative shift continues to evolve. Of course, the US trade policy is going to change trade patterns, even if, as we expect, the US government continues to keep negotiating with itself, continues to blink and scale back the tariffs that actually happened from what was originally announced. The tariffs that were originally announced on Liberation Day was such an act of economic self-harm that we never expected them to be the ones that actually took effect, and we're seeing that already. Now, all of this is colliding with a pattern that we've been noticing globally for some time, which is that people are expecting more of government, whether it's to rescue them out of a crisis or a pandemic, to protect them from harm, to regulate against bad things happening. And those expectations are colliding with different degrees of fiscal space. In Australia, we have a reasonable amount of fiscal space, but there are plenty of other countries, and particularly the US, where this isn't the case. Another big force, which is in some ways unrelated, but really feeds into how we think about the cross-country differences in how all these other forces will shape up, is labour supply. I think most people would have thought that the labour force would shrink as populations age, but as I'm about to show you, that's actually quite different. So let me finish up with just a couple of graphical illustrations of some of these 5 big forces. So if we just move to the next slide, please. The US dollar is manifestly overvalued, although there has been some reversal recently. on pretty much any measure of the real effective exchange rate, the US dollar is as overvalued as at any time since the Plaza Accord. And that matters because it becomes possible for goods and services for other countries to inhabit niches in US markets in a way that you don't see otherwise. We also expect that after, for Australia, after a relative period of stability over the last decade, we'll start to see bigger swings in exchange rates as shocks from abroad are cushioned in large part by changes in the exchange rate. But from the perspective of global investors, this is a really awkward situation because they're very long US denominated assets, but you're looking down the barrel of a further, maybe 15 or so percentage points depreciation in the US dollar over the next 3 to 5 years, if history is any guide. So this is just something to bear in mind that is weighing on a lot of investors' minds. I had absolutely no pushback from any customer while I was away on this idea that the US dollar was overvalued. And so that is going to be affecting investment decisions. If we move on to the next slide. I talked about differential fiscal space. There is a lot of noise in Australia about how terrible it is that we weren't in surplus in the current financial year and won't be for the next little while. But I can tell you that whenever I showed this graph to international customers, the reaction was, well, what are you worried about? You're not the ones with the problem. I think it's very easy to worry about your fiscal position, but then when you compare it to what's happening in the US and a few other countries around, but particularly the US, it's a very different situation. So at a time, yes, you needed to run a big deficit during the GFC or during COVID to cushion the economy. But what is really extraordinary about the US is that they're still running extremely large fiscal deficits at a time when their economy is more or less fully employed. They've just been through an inflation bout, and growth is pretty strong. And everyone was sort of saying, oh, look how wonderful the US is, look how exceptional the US is, and how well it's growing. Well, it's easy to grow well when you're throwing an additional sort of 5.5% to 6% of GDP of demand, and with no end in sight. And I have no expectations that Doge will do much to cut spending. We have we have no expectation of a material increase in tax collections from the tariffs when all is said and done. And even if there were an increase in revenues from those sources, the Trump administration, being what it is, would almost certainly give it that all of that and more back in tax cuts. So, the US is really staring down the barrel of a serious lack of fiscal space, and this is another of the things that is weighing on investors' minds when they confront their TINA problem. If we move on to the final slide, please. Now, I mentioned already labour supply is kind of a really interesting cross-country story when we look at sort of very long-term trends. Most people, if you pop quiz them and say, what happens if the labour market, what happens to the labour market with population ageing? And most people would say, oh, well, the participation rate falls. But it turns out that through, Australia and New Zealand and indeed most of Europe, the opposite is true. And the reason is because population ageing happens because people are living longer, healthier lives. Therefore, they're not retiring early due to ill health. They're noticing that their mother is 93, so maybe they can't afford to retire in their 50s. And also many of these countries reformed their pension systems, knowing perfectly well that with population ageing, they would be unaffordable in their previous configuration. And I've put Germany in there in addition to the euro area because, I think a lot of people misunderstand the role of the Hartz-IV reforms in the early 2000s and are still sort of stuck in a turn of the century view of sclerotic Europe, and it just isn't true. But again, this is where, US exceptionalism is not necessarily a good thing. Canada, there's a slight downtrend. The ageing of the population is outweighing the increase in participation within age groups. But in the US, we've seen, a real tendency to have permanent reductions in participation, and particularly in prime age participation. This is not being driven by older people; it's being driven by younger people in the 25 to 54 age group. Every time they have a downturn, you have a big step down in participation. So the US is actually uniquely handicapped in its ability to drive labour supply upwards. So what's the implications of that? Well, for banking at least, countries like Australia, New Zealand, most of Europe will see a very different balance in the war for talent versus things like an imperative for labour-saving technologies through AI than a country like the US. And so I think we need to be very alive to these cross-country, multi-decade trend differences. That's all I have, given the time available, but happy to take any questions later.
Thank you, Lucy. I think Tina McRae is my new favourite acronym. I'll be using that often. And I have a question for you on interest rates, but I'll come back to you on that in just a moment. Over to you, Warren. What do you see as the big economic forces shaping the economy going forward?
Yeah, great. Well, I think Lucy's given us a good backdrop to some of the issues I wanted to talk about. So I am completely in agreement that we're in a new higher rate structure world, and a little bit worried that we're going to see it continue to drift up, maybe not a full reversal of what we've seen in the last 40 years of interest rates falling, but we're certainly seeing a big, long wave cyclical shift. And that's, of course, we've got inflation back to the point where maybe the period between the GFC and the pandemic was the exception, and we're moving back to a world where inflation being a bit of a constant pain and a bit of an issue is the more the normal. The question that I think we all want to know is, what's productivity going to do? Not just here in Australia now, because it's horrendous, but around the world over the decades ahead, because that is the foundation point. And I want to say that I'm bullish on productivity, maybe not right now in Australia, but over the decades ahead. And Lucy touched on it. I see a tremendous incentive coming through our society for businesses to invest and embrace this labour-saving technology that is represented by supercomputing and AI. Why is that? Because of this big shift in the demographic cycle. We've gone from a world since the 1960s of the working age population share growing every year compared to the size of the overall population, effectively more supply in the economy compared to the demand, and that's all turned around. We've gone from a world that unemployment was the issue, particularly when the economy was weak, to now a world of labour shortages. And of course, that's fundamental demographic signal or shift is sending signals, and we'll continue to send signals to invest in this labour-saving technology. So for me, to solve for that, we get the productivity, the technology's there. Australia has to embrace this, and of course, the data centres, the energy supply for them are all part of the mix. We can all debate whether it's happening quickly enough. Is there an issue? Over the longer term, I am bullish. And of course, if you've got both a bit more inflation and productivity, you're going to have both of those putting upward pressure on rates. But look, let's get to a couple of comments at the first slide on Trump. And look, my context here is what are the ultimate motivations? The transparent one is what we all know, and that is the reindustrialization of the United States economy. So I've stolen this, I believe, from the IMF, and that is China's share of US goods imports. Trump's original tariffs had a bit of an impact. Of course, the manufacturing didn't come back to the US. It went to what they were calling connector economies, Vietnam, Indonesia, Mexico, and others. And it looked at one stage like he was going to go for all the other economies, but I think the ultimate motivation of what they're doing in the US has been revealed with a geopolitical objective. That is, the Chinese economy is struggling, is dealing with a number of problems. Their model may or may not be sustainable. And in the spirit of Reagan and the Soviets, let's try and push them over the edge in this geopolitical contest. Economic mass is the end game. Look, that's all speculative. So I'll leave others to judge whether or not that's an objective or will be successful. If it is the objective, of course, this trade war is not going away anytime soon, and who knows what fireworks could happen in the meantime. But look, to the original idea that they're trying to get a revival of US manufacturing, this is from the IMF. They just put some data up in index form of investment in manufacturing facilities. This is a level versus output. We're not seeing a meaningful shift in output, but there is investment coming through. Are we to expect that? If you get back to my demographic concern about labour shortages, there is a question of whether they have the people to fill the factories, although they will probably be very high-tech factories. But there is seemingly some movement happening in US manufacturing. Look, I don't think any self-respecting economist, certainly not Lucy or I, would be saying that this strategy is anything but dangerous and it's destructive. It's a matter of who's going to take the biggest hit. No one knows what's going to happen. We've never seen anything like this before. We are unfortunately in the middle of it, not necessarily in the short term. We, I think, are fairly robust in terms of our major primary goods exports to the situation in the short term, but you never know. We basically sell to China and have our security guaranteed by America, and that seems to be somewhat problematic. So that's the great uncertainty. If we just, to finish up, switch back to Australia, the next chart. Look, I see the real sort of concern for me is again, to Lucy's question of fiscal space. We have seen a massive structural shift up in the size of federal government spending. This data is straight out of the national accounts. The statistician calls it consumption spending. I sort of characterize it as recurrent or locked in. This is the care economy. This is the economic strategy of the current government, which they're taking to this election. And I've taken out the pandemic spike just to sort of take that out of the picture. The question here is, what does this mean? We haven't seen a shift in the size of Australian government like this since the late 60s, early 70s with the introduction of the welfare state. A hallmark of our economic structures through the period of reform, and this is of great prosperity that we developed over the last 40 years, was disciplined government, was governments that got their budget back into balance, kept debt low. And look, we're in a democracy, and maybe the mood has shifted and we do want bigger government and we do want more spending. I suppose the one thing that worries me most is through that 40 years of modest government characterised by the Charter of Budget Honesty, by low government debt, we built up the world's largest household sector debt, or give or take. And what concerns me is this, in macroeconomic terms, reasonably quick shift in the size of government. Does it have implications for other financial structures, like household debt, mortgages? And maybe also operationally, is there any issues about crowding out and impacts on the private sector? These are things we're needing to watch. I think it is time for a bit of a breather on the expansion of government in our economy, but we will see. And then to the point, how does that overlap with the labour shortages? This is job vacancies. I think it's pretty clear what the message is here, and that is that we have a very scarce resource and we have to shift our thinking. Economists for generations thought unemployment was the main problem, the main issue. Some thought that was the problem with capitalism. The reality, I think, is that we've gone through a demographic shift where unemployment is no longer the macro problem. It might be a micro problem. And for banking, what concerns me or worries me most is that we may be on the cusp of a major sort of ordering of our labour market to make sure that those scarce labour resources are dedicated to their most productive use. And this country has got one of the lowest job mobility records in the world with that high debt. That might be part of the issue. Does this get to a point of being forced through a recession? I don't know the answers to that, but in terms of the world of banking, given how important the mortgage side of the business has been, I think that long-term story has run its course. I think we're no longer a consumer-led economy of the last 30 years. It's an investment-led economy. And of course, there is the potential in such big shifts for short-term disruption. So I am very positive long-term, assuming we can get through this geopolitical issue. But in the short term, there's potential for disruption. And of course, that may be playing out in the short term, as in the next 6 months, or it could be something that plays out over the next few years. Right now, we know that business profits are under pressure, and we know they're struggling to pass on costs. So, you know, there's a lot of variables at stake. It's an uncertain period, radically uncertain period. But I would expect to see a lot more volatility, and bankers need to be prepared for that. And of course, that issue of credit and credit losses, which has been a pretty good part of the Australian banking story for the last 30 years, since the early 90s, may well become more problematic or more of an issue in the decade ahead. I'll leave it at that. And thank you.
Warren, much appreciated. Just to finish off with you, and then I'll throw back to Lucy for a second. What does all that mean in your view as the forward path for interest rates?
Yeah, so I think after a sort of a decade or more of the a misalignment, if you will, where real interest rates sort of detached from the underlying sort of growth fundamentals of the economy, rates were low. I think we're going through a period where that will realign, whether that's in the next few years or it takes longer. So I think we're headed for higher interest rates. I think the cash rate will average above what it is now over the next decade, and it will average well above it in 5 years' time. And as for the short term, I think there's a little bit of scope for the RBA to take out some insurance with a couple of rate cuts. I think to their mind, the cash rate is neutral around 3.5. I think they'll probably be happy to use that couple of rate cuts up as insurance, but beyond that, I think they've got very limited scope. And of course, if the real shock to the economy comes through our traded goods sector, through the exports to Asia, then it's the currency that will perform most of the role in helping to make adjustments and buffer our economy and the government's budget to some extent. So maybe a couple of rate cuts in the short term, but I think longer term, we should be prepared for higher rates.
Thanks, Warren. And Lucy, your view on the forward path for interest rates?
Sure. I mean, we haven't changed our base case of 3 cuts, but it has to be said that, a great big dose of extra uncertainty really has flipped the risk from, hawkish. The risk had been that, the RBA was still very uncertain, was taking very seriously the changes in the statement on the conduct of monetary policy that require, that says, you've got to be getting down to 2.5, and there they were with their forecast at 2.7, fine tuning. As I pointed out, and and the response from, and Andrew House's speech was, oh, well, some may say this is fine tuning, but you have to understand that this is a requirement of the statement on the conduct of monetary policy. It's like, yeah, that's what I said. And look, honestly speaking, Glenn Stevens would never have purported that they should be fine, that you could or should fine tune in this way. So they are going to tilt more hawkish because of the nature of how they're interpreting their policy mandate and how they're interpreting the labour market. I mean, we'll note the graph that Warren showed on job vacancies. The more recent data has come off a bit, and the NAB survey showing, the difficulty finding suitable labour, after sort of, hovering around in the second half of last year, has actually legged down again in the early part of this year. So, one of the things I worry about in this country is, we know that, wages growth was well below what you needed to sustain inflation at target prior to the pandemic. And I think we sort of, no one ever quite explained. I mean, there was something, when we were at the RBA, no one could fully understand why that happened. I think that, to my mind, the issue around the global structure of interest rates being higher is actually a real rate story. It is just, real rates were unusually low in that period between the GFC and the pandemic. And so irrespective of whether central banks are undershooting their targets or meeting their targets. So in a nominal sense, real rates are also just going to be higher for those savings investment reasons I was speaking of. So, we do see, our narrative had always been the RBA was going to be continually pleasantly surprised on inflation and wages growth. It's been very worried about the tightness of the labour market. And while Warren's right that, ultimately, the ageing of the population does push you into a labour force shrinking position, that's not where Australia and New Zealand are now. We are in the phase where ageing the population expands the labour supply with people who are retiring later and women who are not staying, who are staying in the workforce rather than taking as much time out, to care. So you're talking about older workers and mums being more likely to be in the workforce than previously. in an 114-year high in participation. That's a participation rate for everybody aged 15 and over, so it includes the over 65s. So at the moment, the relative imperative to do labour saving technology in Australia is less than it is in the US, where they are unable to produce that labour supply. So there are going to be, cross-country differentials with this. Does the RBA sort of appreciate this at the moment? I'm not sure that they do. I think they have been very, very bearish on wages growth and productivity. Productivity growth in the non-mining market sector has been the same since 2021 as it was in the decade between, the decade up to 2017. All that's changed is, A, the increase in the care economy, and B, coal production's gone down 15% over that period, which has got nothing to do with domestic, wage pressures and inflation pressures. So, does the RBA sort of fully appreciate that yet? Not sure. That's probably one of the reasons why they will remain a bit hawkish. But yeah, we see, three cuts with downside risk.
Great, thank you, Lucy. All eyes are on the RBA for May 20th. I think the markets are fully priced for a 25 basis point cut, but we will see what happens in a month or so. We're going to move on to Richard Wiles at Morgan Stanley now. We're going to get a bit of the analyst perspective. Richard, as you look at the banking sector, what condition do you see the balance sheets in as we enter into this next phase?
G'day, Steve, and thanks for having me. Good afternoon to everyone. Simple answer to your question, Steve, is that balance sheets are in good condition. They're certainly stronger on most metrics than at any time in the past 30 years. Whether you look at capital, funding, liquidity, or provisions for loan losses, there's a stark contrast to where the banks were in 2018 when they were so adversely affected by the global financial crisis. We have a slide that hopefully we can bring up. As we highlight on this slide, capital ratios have risen consistently and are still close to their peaks, despite billions of dollars of buybacks from the major banks over the past few years. Provisions for loan losses that could go bad are above historical levels and are not far below the COVID levels of 2020, which placed a very high probability on downside scenarios. On the left-hand side, you can see that reliance on wholesale funding has reduced dramatically over the past 15 years. It means that refinancing risk is a lot lower than it was in the past. And finally, on the bottom right-hand side, you can see liquidity coverage ratios are well above minimum regulatory requirements of around 100%. So even though the return and growth profile of the banks has declined in recent years, we think their balance sheet strength is a key factor which has supported bank share prices. It means they're less vulnerable to some of the global and domestic challenges which we've just been talking about, and are certainly top of mind for investors at the moment. But so to conclude,
say,
Steve,
Richard,
yeah.
Sorry, please finish.
Was having said all that, we should keep in mind that the Australian banking sector does remain highly concentrated. We've got outsized exposure to residential mortgages, and we do have an ongoing reliance on offshore funding. And these are the reasons that David Murray's Financial System Inquiry concluded in 2014 that banks do need unquestionably strong balance sheets.
Yeah, that makes sense. And just going back to offshore wholesale funding, your view is that we've limited but not completely reduced that risk, so it remains but more muted than in previous years.
Well, that chart in the bottom left-hand corner shows you that the share of funding that is made up of deposits has increased significantly across the bank sector, from something like 45% to above 60%. The majors are more like 70%. So this is a good trend. This is a key reason why investors are not as worried about funding or liquidity risk as they were in 2008. It's meant that the reliance on wholesale funding has reduced, particularly the reliance on short-term wholesale funding. But as the chart shows, there still is some long-term debt. The majors, have typically issued sort of anywhere between sort of $25 and $40 billion of long-term debt each year, and that's per bank. It's coming down. It's well supported by offshore fixed income markets. There's lots of diversity in that debt issue, across type of product and also type of investor and geography and currency. So it's much, much better than it was 15 years ago. But the simple fact is our banks still need to issue long-term debt in offshore markets.
Absolutely. Thanks, Richard. And if we move across to key metrics, then what are you seeing from a loan growth perspective, from a net interest margin perspective?
So this is covered in our second slide. So in general, sort of we're quite cautious on the bank's growth prospects or earnings growth prospects, although we do think that their operating trends are going to be quite stable in the next few years. On the mortgage growth front, we're expecting around 4 to 5% per annum at the system level. I think the potential for upside is constrained by the high level of household gearing. That's something that Warren touched on in his comments, and I'd certainly agree that this is an issue for the economy and an issue for the bank sector, and it is likely to constrain overall volume growth. In terms of margins, we think the prospects for margin expansion are limited by competition. Our forecasts are included in the bottom left-hand corner. We'd note that all four major banks in recent years have narrowed their business mix. They're all focused on winning or maintaining share across retail and business banking. And this drives more competition. It's one of the reasons we think that margins are unlikely to expand from here. Overall, Steve, I'd say our forecasts are for low to mid-single digit earnings growth. That's okay, but it's certainly lower than the level during what we've called the bank super cycle, that period from the mid-90s through until about 2015, when the earnings growth of the major banks was typically double digit most years.
Yeah, thank you. Turning to challenges and risks, I think you've pointed to a few of them there, but what are some of the risks that you see to the banks maintaining some of that growth trajectory?
So I think we could come up with a long list of challenges facing the banks. Some are quite large, some are minor, some are temporary or cyclical, and some are structural. But I'll touch on a few that I think are most relevant for the year ahead. And I'll put aside the one which Lucy and Warren have been talking about, and that's the uncertain global and domestic economic environment. I don't think that's an issue for me to talk about specifically. So the ones I want to mention, the first is the near-term impact of lower rates. In broad terms, lower rates put downward pressure on margins. So if we do get some rate cuts, as most expect in the year ahead, that is an earnings headwind in the short term. The second challenge is the potential for deposit mix shift over the next year. We've observed that deposit pricing trends have actually been very stable, but there has been a shift from lower cost deposits to higher cost deposits, and particularly from traditional savings accounts like CommBank's NetBank Saver to bonus saver products. So, for example, CommBank's Goal Saver. That's a potential headwind for margins and earnings in the year ahead. The third challenge I'd highlight, Steve, is the risk to returns in both retail and business banking. I think this is a significant investor a significant issue for investors at the moment. I mentioned competition amongst the largest banks. That's one of the factors that has led to lower returns in retail banking over the past few years. I think all of us on this webcast can recall when retail bank margins were very healthy. That's no longer the case. And we think a sort of focus on growing share by all of the 5 largest banks in Australia, as well as the absence of alternative growth options in offshore markets or in adjacent parts of the broader financial services industry, is an important reason why returns have come under pressure. A final challenge I'd identify is the need to deal with legacy technology. We're seeing this most obviously at Westpac as it embarks on Project Unite. That's a 4 to 5 year project. It's going to cost something like $3 billion. It covers 60 different initiatives, and it's impacting all parts of their Australian bank, so retail banking, business banking, and institutional banking. It's clearly an issue at Westpac. It's also a big issue at ANZ. We think ANZ spent something like $1.5 billion on its ANZ Plus platform. It's been planning and building that platform for something like 5 years, but the migration of more than 6 million customers is really only just getting started, and it probably won't be completed much before 2028. So at ANZ and Westpac, the sort of need to deal with legacy technology is very sort of front of mind for for investors, for both the sell side research analysts and the buy side investors. But just because it's high profile for those 2 banks doesn't mean that all banks don't have to deal with the challenge of legacy technology. NAB recently has highlighted that it wants to modernise its technology, and even CommBank, which is widely viewed as a technology leader, continues to grow its cost base and continues to grow its headcount. And those 2 things, I suppose, limit the benefits of technology, limit the benefits of scale. So there's a lot going on, Steve, but they're the sort of 4 main challenges that I would highlight for the banks in the year ahead.
Thank you, Richard. That's fantastic. We might move to Claire now. And Claire, I don't envy your role right now. We've had a huge long list of global economic shocks. We've talked about a lot of the challenges that presents for our local banks in really thinking about and responding to this next phase of the global economy. Thinking through all of that from where you sit, how do you see the strategic agenda of an Australian bank pivoting in this year ahead?
Thanks, Steve. It's great to be here. Look, I probably think it's a mix. Some things pivot, some things stay the same. We obviously, and I think all banks are keeping a close eye on risk in response to the volatile and unpredictable external environment that we're in. Certainly seeing the potential exposure for particular customer segments very differently depending on, say, industry or exposure to international markets. So we see that playing out differently, for example, with our customers who might be in agriculture versus manufacturing versus shipping. So it's I always say the Australian economy is like a patchwork quilt. It's like a real patchwork quilt. There's no one consistent answer for any customer segment, industry or geography. And so I think we've got to sort of bear that in mind. It's not just sort of a one size fits all. And also, I think the other thing I just want to comment on before I speak to sort of specific bank potential pivots is that there's an industry-wide approach that I think we take in this market that's it's served us well in previous periods, particularly saw it on display during COVID and GFC. But I think, all banks have got to optimise their own strategic agenda based on their own strengths and weaknesses. But there's a broader industry lens that we apply. And in that regard, I think, the role of organisations such as the Australian Banking Association, the ABA, is so valuable because it provides a voice with government, with other important stakeholders and counterparts that allows us to operate in a way that I think is, net productive in times of stress. And so I've certainly seen just over recent weeks, that swinging into focus again. And I think it's something that, we don't always agree, we don't always necessarily align with perhaps government policy, but we have a productive way of engaging and getting through times like this, and it's good for the country, I think. So from an Australian perspective, I see that as real positive. Back to individual banks and pivots, one of the things, I can obviously only speak for my own organisation, ANZ, we're very much focusing and filtering the world through a lens of what does that mean for our strategy? What would change if we believe certain things to be true? One of the things that we have certainly seen our clients demanding more of is support with trade and capital flows as they look to maybe pivot their own operations. We're certainly seeing more demand for those products and services. We're the only bank with a presence in 29 markets. And so we're seeing a lot of our Australian exporters looking to ANZ for support with that sort of business. It's something that probably wasn't as much in frame, I would say a few years ago, but it's partly being driven by just that client need. Another example would be if you speak to any private bankers in the market, they'll tell you that clients are increasingly looking for insights and portfolio guidance during choppy times from an investment perspective. One thing I think doesn't change and has come through a few times in this session today is technology. Technology from a strategic perspective, it's just an imperative for everyone. I think, Richard touched on that real investment required as the banks move from legacy systems. I think that remains, and it just shifts over time in terms of the way you deploy it. So for example, AI, AI is changing where you may place those investments and the way that we can add value for our customers using generative AI, but also internally for the organisation and people doing their jobs. So I think there's some really good examples of things that are changing, but also things that are staying the same.
Thank you, Claire. And you spent a little bit of time there on growth, but let's just unpack that a little bit further. Where do you think those growth pools, those growth pockets really exist for Australian banks, whether that be by channel, by segment, by product and service?
Yeah, absolutely. I think sometimes we take a very narrow lens on growth, particularly when it comes to our sort of definition of the way we value our banks in terms of NIM and volume, and some of those metrics obviously really important, and they are the key drivers of revenue and NPAT. That is true. But I also think there's real growth opportunities in just doing banking 101 really well. And some of the pressure on the industry, pressure on NIM, for example, drives a focus on things like efficient deposit gathering, getting that compositional mix right, funding and liquidity, capital stability and efficiency, risk management. We heard a bit about some of the concerns around that. And supporting our Australian customers through the cycle. So I think just doing banking 101 well, there's still quite a lot of upside in that, particularly things like optimizing your funding mix, for example. But obviously, just wearing my hat as the group executive for the Australian commercial business, I obviously am, standing in this role because I believe in Australian businesses, and I think that there's a huge opportunity in business banking. There is no doubt it is very competitive. There is no doubt that it is very hard to gain share profitably in the market. But at the end of the day, there's still 2.6 million businesses in this country. They're generating about 60%, if not more, of our GDP and employment, and they are underbanked structurally relative to other markets. And so I think there is still an opportunity to do more by penetrating that customer base more from a business banking products and services perspective. And also it's a less commoditized market than perhaps the more monoline sort of mortgage style product. And so I think the opportunity to serve that whole of customer and those needs, customer needs, are also evolving, and the things that they're looking for their banks to help them with is changing. And so I think there's opportunity there. The other thing I'd point out is I think increasingly, and it goes back to this technology, which seems to be an overarching theme, is that our customers are shifting where and how they expect to be banked. And I think there are growth opportunities in that as well. And so, for example, digital services are playing a much more important role. Customers want simple needs met via digital channels, doesn't necessarily have to be in their banking app. But we want to be able to provide fast and efficient and insightful services to them. For some of our larger complex customers, we see that there's no getting, they want a human relationship, they want face-to-face, and they might want some digital support, but we need to do both. We need to do both well to be successful in business banking. So that's an example of a market where I still think there's growth opportunity, as hard as it is. I think there's a way for banks to differentiate in that space. And I think it's a healthy thing for the economy if we think about it as more than just size. It's actually about what's you're offering in the market and how can you serve the needs of Australian businesses. That's good in terms of deploying capital. And again, I'm like Warren, net very bullish on productivity in this country if we can make sure that capital flows to the right opportunities.
Yeah, that's great. And on the risk side, we've talked a fair bit about some of the risks that exist out there, but what do you see as some of the risks that are perhaps a bit newer for banks to manage versus the ones that are more traditionally known and understood?
Yeah, look, I'll probably leave the credit risks well enough alone because I think we've covered a little bit about that. The only thing I would comment on the collective provisions, one thing I've observed for some time now is that the amount of buffering that's going into those collective provisions, because there's some inbuilt conservatism, in various, overlays that we put in to say, actually, we're just not sure, particularly, for example, the outlook for small business in this environment. Let's add another layer of conservatism into our provisions, just because we want to make sure we don't get that wrong. So I think the forecasting risk in CP in particular is obviously increased, and so therefore we need to be quite conservative on that. I think, though, if I turn away from credit risk and just think about emerging risks, it's a regular discussion. It's important that we have really diverse voices at the table in those discussions, because I think different people with different experience are seeing the current landscape really differently, and I think that's an area where diversity of perspective is really important. We spend more time, I can say we definitely spend more time now on geopolitical risk than we did 12 months ago. That is just absolutely on the agenda all the time as we all try to make sense of it. And then I think some of the security-based risks, they're not new necessarily, cyber scams and fraud, but they're ever changing. And so we've got to remain vigilant. And so you can't just sort of say, oh, we've mainly managed that. You've actually got to continue to adjust your settings with respect to security. And then I think the other thing, we touched on it lightly, I'll just sort of give it a nod, I suppose, is really being mindful of social license and the role we play in the national agenda. Things like housing affordability, obviously at the forefront at the moment during an election campaign. But, there's a role for all of us to play in that. And I think, again, that probably goes back to the point of how we interface with the government, what mechanisms we can deploy to ensure that, affordable housing is a reality in Australia, be that through some of our more sort of infrastructure or private-public partnerships and the like. I think there's a role for banks to play in that, yet also risk from a national perspective.
Yeah, thank you. And going back to what you're saying about technology, there's definitely something in there around artificial intelligence driving productivity, but I'm interested in your comments around making it personal and trying to personalise that, particularly in the context of quite a diverse set of business customers.
Yeah, customers are just expecting it. I think the game has really shifted in terms of what customers expect when you collect their data. They expect something in return. What are you giving me in return for the deposits that I give you, for example? You see my payment flows. Deposit gathering is obviously important for a bank from a funding perspective, but it fulfills a fundamental customer need first and foremost, which is taking payment, making payment, providing a safe store of wealth. All of those things are data points, and we need to be able to, just as an example, and there's a lot of other data there, but that's an example of where customers are expecting insights from that. For example, help me manage my cash flow in return. So I think there are that customer voice in terms of the expectations around data and insights is really shifting.
And it's a great reminder that when we're talking about growth, sometimes that just means listen to your customer and follow the trail of what they need and how that evolves. Thank you, Claire. That's great.
Thanks, Dave.
We've got a few minutes left, which we've kept open for audience Q&A. So if there's anybody on the line that would like to ask a question, you'll see at the top of your screens a little Q&A button. So please feel free to press on that and type a question into that function there. We've got one question here from Paul Holmes. There are places in Florida where lenders do not lend mortgages to buy a particular property and insurers do not insure due to climate risk. Do you foresee similar things happening in places in Australia? We might need APRA for this one, but I'll throw that one open to the panel. We've obviously seen some significant impacts of climate risk on certain housing areas in Australia, and there's definitely been a lot of conversation about insurability. Claire, I might throw to you on that front, see if you've got any observations.
Yeah, I think it just goes back into that mix of what do you look at when you're approving a mortgage. Obviously, you've got to look at things like climate risk, and that might be done on a postcode basis. But I don't, I certainly see, and we, probably question for the insurance companies, but we've certainly seen an increase in the cost of insurance in certain areas as a result of some of the exposure or perceived exposure with respect to expected losses that are feeding into the models. So I think you definitely see more stratification in terms of pricing and in terms of insurability and access playing out as a result of climate change.
Yeah, that makes sense. Question from me back to Warren and Lucy. Just on the bond market, it's been really interesting looking at US bond yields. So the short-term and long-term yields seem to be diverging, and there was an AFR article today saying the US 2-year rate is falling while the US 10-year rate is climbing, which seems to show a short-term expectation of rate cuts, but a long-term lack of faith in the US economy. We've obviously seen a lot flow through the equity markets so far. What do you think the impact is going to be of all this change as it reflects through the bond market? You're on mute, Warren.
Yeah. Warren, you go first if you want. I'm happy to.
You go. Sorry, I was on mute.
Yeah. Look, I mean, it is the the quintessential bear steepener. The fiscal position in the US is dire and not getting any better. I do wonder actually whether the short end, has some risks in it as well, because this is fundamentally an inflationary shock. It's a stagflationary shock. And so, to the extent that it does actually take effect, and I think that's, in doubt, it is contractionary for the US relative to everyone else. And I think, but inflationary for the US relative to everyone else. And I think, they're the kind of things, it's the cross-country elements of this that I think are also important from the perspective of investors deciding where to deploy deploy their funds. The Fed does have a real dilemma here that the economy is actually still doing okay. It hasn't fallen in a heap yet. All of the concerns about delay to investment projects because of uncertainty, well, that hasn't happened yet. People might not be making decisions, but you make a decision now, the project doesn't start for a while. They're not just stopping building what they're already building because of that uncertainty. Anything underway is already happening. But it is just, that's fundamentally a bear steeper. People are worried about the state of the US economy, but they're also worried about the state of the fiscal position of the US. And that, in terms of what that then means, I mean, the US, unlike Australia, bond yields do matter for, wider interest rates in the market. It doesn't, fixed rates are not that important in the Australian market, but they are in the US. And so this is also a financial tightening on the household sector. So that's another source of contraction.
Thank you, Lucy. And Warren, maybe 30 seconds before we wrap up?
Yeah, super quick. I mean, I think we saw some dislocations in the way the US Treasury market was working that were genuinely scary. And I don't think at one stage, and I was a bond strategist for a long time, I've seen the magnitude of rise in long rates versus the magnitude of the fall in short rates at the same time like that. So that's probably why Jamie Dimon called Trump. To the point, though, and I agree with all of Lucy's points, And adding to it, it does talk to this sustainability of government finances, because we've had a world where those falling yields, the bull's flattener, that is long rates coming down in quicker than short rates and then short rates falling. If that's all reversing, this world of big government deficits and big government debt in other countries is under question. We're well positioned in this country relatively, but the 10-year yield going up, whether it's in America or Australia, that hurts the government the most. That really puts pressure on that government funding. So that's the thing I'm sort of thinking about in the backdrop, on top of the points that Lucy rightly made.
That's great. Thanks, Warren. All right, conscious we're at time, I might throw back to Craig at the ABA.
Well, thank you very much, Steve. And look, on behalf of the ABA and our members, I'd like to thank Lucy, Warren, Claire, Richard, and Steve for sharing your insights today. And just for our members, a reminder for upcoming events, including our Economics and Future of Banking webinars for 2025. Please keep an eye out for our weekly alert, or please visit the ABA website or member portal. And for all of our members, if you'd like to join us at our annual banking conference, which will be held at the ICC in Sydney from 23 to 24 July, please go to the ABA website for further information. But once again, thank you to all of our panelists today, and thank you all for attending, and have a great day.